market decline doesn't have to derail your retirement, but it does require a smart, intentional strategy. So the biggest financial threat that most pre-retirees have not heard of is called sequence of return risk. And understanding it is the foundation of everything else that we're going to talk about today. And here's the concept. It's not just what your investments return over time, it's when those returns happen that can matter the most. So imagine you've got two scenarios, two retirees. Both earn the same average return over 20 years. But one experiences big losses early in retirement while the other experiences them later in retirement. The retiree who took the losses first, while they were actively drawing down their portfolio, runs out of money far sooner. Same average return, but totally different outcomes. Why does this happen? Well, it's because when you sell your investments during a downturn to cover your living expenses, you're locking in those losses permanently. You don't get to wait for the market recovery. You've already spent that money. The decisions you make in a down market right when you retire can have an outsized impact on whether that money lasts 20, 25, or 30 years. So what do we do about it? The first strategy is called a cash wedge, and it's one of my favorites because it gives you peace of mind and financial protection at the same time, and it's just so simple. You keep 1 to 2 years of living expenses in cash, meaning a high yield savings account, money market, or a similar low risk vehicle. This is your buffer. And when the market is down, you draw from the cash cushion instead of selling your investments at a loss. You can let your portfolio sit, give it time to recover, and in the meantime, you sleep well at night knowing that your bills are covered. As the market recovers, you replenish your cash wedge and the cycle continues. It's a simple concept that can make a real big difference. Strategy number 2, as much as possible, try to live off the income that your portfolio generates. This could be dividends, interest, rather than selling shares. So if your portfolio is built with dividend paying stocks, REITs, or bonds, that income keeps flowing even when share prices fall. Markets could drop 20, 30%, but many quality companies will continue paying their dividends. And by relying on that income stream, rather than selling assets, you preserve the number of shares that you own and the income that you receive. So when the market eventually recovers, and historically it always has, you still have all those shares participating in the rebound. Now, this works best when you've intentionally built an income generating portfolio before you retire. If you're a few years out, this is a great time to review whether your holdings are set up to produce reliable income. Strategy number 3. This one takes a little bit more discipline, but it can be incredibly powerful during pullbacks, is to temporarily reduce your spending. I know no one wants to hear spend less, but this isn't forever. This is a short-term adjustment window where every dollar that you don't withdraw is a dollar that stays invested and can recover. So even reducing your withdrawals by 10 or 15% for a year and a half during a bear market can meaningfully extend the life of your portfolio. It's one of the most powerful levers that you have. Strategy number 4 is, does your portfolio make sense? What's the makeup of your portfolio? Because not every retirement portfolio is built the same. And what was right for you at 45 may not be right for you at 62. The classic question is, how much should be invested in stocks versus bonds? In a bear market, a heavily weighted portfolio to stocks will feel a lot more pain. That volatility is a lot harder to stomach when you're living off your savings rather than adding to them. A more balanced allocation with meaningful portion in bonds or fixed income can reduce the severity of those swings. So I always encourage people to think of their portfolio not just by its growth potential, but by how it will behave in a downturn. Because in retirement, behavior matters as much, if not more, than the actual performance of your investments. If you're heading into retirement, here's the game plan to prepare for a bear market. Protect yourself from sequence of return risk by building a cash wedge. Let your dividends and income do the heavy lifting when possible. Be willing to flex your spending in the short term in retirement. Make sure your stock to bond allocation actually fits where you are in life and not where you were 20 years ago. None of this has to be complicated. It just has to be intentional. The common thread amongst all of these strategies is to avoid selling your growth investments, your stocks, at temporarily depressed prices and give them time to recover long term. Thanks for watching, and I'll see you in the next one.